Welcome back, everybody. Stefan Morris here with AdviseRE. Let's jump right into what we're going to talk about today, which is the difference between being an investor in real estate versus a dealer in real estate and what the tax outcomes of both might look like. So here's an example of how it might play out. You just bought a piece of property, and after doing some work to it, maybe over the course of 1 year, you eventually decide that you're going to sell the property, and the resulting gain is around $100,000. You're very happy, you're looking forward to a 20% long-term capital gain rate and thus paying only $20,000 in taxes to the IRS, but that might not be the result of what you actually realize. In fact, you might end up paying somewhere between $40,000 to $50,000 in taxes, considering that you'll be paying an ordinary gain of 37%, in addition to Social Security and Medicare taxes, which could be upwards up to 15%. So how can this happen? Well, it's going to depend on whether or not you're a dealer or an investor in real estate. Let's dive into what an investor looks like. Under the code, specifically Section 1221, an investment is defined as something that it is not. And what it is not is something that's held as inventory primarily for sale. And so an example that I mentioned right before, an outcome where you're paying $40,000 or $50,000 a $100,000 gain would be because you held that property for sale as inventory. Whereas had you had it as an investment, then you would be allowed to take a long-term capital gains treatment, presumably as you held it for over a year, at a rate of only 20%, thus the $20,000 tax payment. So what makes you a dealer versus what makes you a real estate? Well, there isn't a code or a regulation or anything specifically in the guidance that we have available to us, which gives you a bright line test on what it means for you to be a dealer versus investor. What the tax courts and the IRS ultimately look at is a body of evidence surrounding your investment or sales activity over a long period of time. So for example, if you're selling properties, let's say once every 5 years versus 5 every single year, in the situation where it's once every 5 years, you're looking more like an investor. We're not guaranteeing you are, just stating that you're looking more like it. Versus if you're selling 5 of them every single year, you look more like a dealer than an investor. They're going to look at the nature and the purpose of the acquisition. Was it primarily to sell to customers, or was it primarily for investment? They're going to look at the time and the extent that you've held the investment. Did you hold it for a short period after you completed your redevelopment or your repositioning, or did you hold it for a longer period of time? They're going to look at whether or not you have a sales office. If you have a sales office where you're actively looking for buyers to buy your properties, you look more like a dealer. Whereas if you're an investor, you probably are engaging in brokers once in a while, and they're going out and looking for buyers for you when you're ready to sell that investment. They're also going to look at the sustainability or the frequency of your sales. So for example, as I mentioned earlier, if you're selling properties once every 5 years, but you're consistently selling properties once every 5 years, maybe you might be looking more like a dealer versus if you're holding them for various periods of time, but generally in the long term, you look more like an investor. Nothing that I'm stating above here is a smoking gun or a red line that says, hey, you're absolutely a dealer in any particular situation versus an investor. But again, it's going to be the sum of the whole that's going to determine whether or not you're a dealer or investor. To give you a feel for how this might play out, I'm going to give you an example for the same general piece of property held by 3 different individuals and what their tax outcomes are generally going to look like. So for example, an owner of a piece of farmland out in the middle of California has 500 acres, and after some time they decide they want to get out of the farming business and they're going to sell it. And who do they sell it to? They sell it to a national home builder. National home builder would then acquire the property, and the seller of that farmland would realize a capital gain, similar in nature to how a sale of stocks or bonds in the public market would look like. It might be subject to net investment income tax and so on and so forth. That national home builder would then take the property and subdivide it into maybe 1,000 lots, and they would sell those lots individually out to multiple buyers. The outcome of their treatment is most likely, almost guaranteed, to be the sale of ordinary gains in the form of selling inventory. So they would have to pay somewhere upwards of 37% as a top ordinary rate, or if they're a corporation, which generally they are, then they're paying 21% for the corporate ordinary rates. Finally, you acquire one of those homes and you decide to rent it out to a third party for, let's just say, over the course of 5 years, and you ultimately sell the property. that would look like a Section 1231 gain, which should be subject to long-term capital gains rates of 20%. Notice how we're talking about the same piece of property, but it's 3 different owners and 3 different uses, and as a result, they have 3 different tax outcomes. So ultimately, if you're the type of investor that is selling frequently and you're concerned about whether or not this dealer versus investor status might trigger a certain different tax outcome than you were hoping for, then please feel free to reach out to us over here, and we'll be more than happy to assist you with analyzing that particular transaction. Thank you so much for watching, and hope to see you soon. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.